characteristics of a spike low: a very long candle wick and a small body, with the top candle being much longer than the bottom candle, and that forms a spike high. And look what happened. We got a little retracement back to that 200-hour Bollinger Band, and then the price just crashed down because it was unable to remain at these levels after this very clear spike. The longer the spike, the better, and that means the reversal becomes more and more probable. Let's go across a little more. There's another spike high up through the Bollinger Band. Although we didn't get much of a movement down, we just got a little movement there. There's another spike. But these aren't classic G7 entries, but I'm illustrating them to you for the sort of things you should look out for. Let's go across a little more. There's a reversal that wasn't really heralded, but I want to point out this candle pattern to you because it is quite important. Those two candles there are actually reversal candles, and you can see, well, we just had a little movement down. I'm not going to concentrate too much on those right now. I'll come back to them. So let's just go along a little bit. There's a few reversal candles there, but they're not all that clear. There's a good example. It's not a pure engulfing pattern because this body here hasn't engulfed that one properly, but this is an example of what's called a it slips my memory now, a piercing pattern, but I'll get back to that in a minute. Right, here's a very good example. I'm going to go through all these examples as we come across them on the charts because it's much easier for me to give you these examples on real life charts than trying to sort of read them out in a book or something like that. Can you spot what this one is? It's a very clear bullish engulfing pattern. Look where we are in relation to the two Bollingers. The stochastic isn't quite oversold, but what we have here is stochastic divergence. Now that's something I want to talk about perhaps in later videos. But what divergence means is you can see the price is moving downwards, but the stochastic, and we're making new lows on the price all the time down here, but the stochastic is moving upwards from an oversold condition. And that's called divergence. In other words, the price is going in the opposite way to the stochastic after being oversold. And we get that divergence, which is often a sign of a reversal. I know it's not in the G7 book. It's a little bit too advanced for most readers, but for those who are more experienced in trading and know what divergence is, you'll know what I'm talking about. But look what happens here. We've gone through the two Bollinger Bands. It's a very, very clear signal. And whenever we get a price moving through the two Bollinger Bands and we get a dramatic reversal like we have here, it's always a very good sign. And you can see this bullish engulfing candle. We've not only engulfed the candle before that, but we've moved up sharply. And in this case, we'd have to have a little bit of a large stop loss because we would have got in somewhere around 44.60. And you can see the low here was just above 43.60. So that would give us a 100 pip stop loss, which is really too big. But it was a very good, very clear reversal signal. So if you really want to get into the trade and the stop loss is too big, there's a very simple solution. Simply reduce your leverage so that your stop loss is equivalent to the original stop loss. So let's say I'm trading at 10 to 1 leverage and I need a 100 pip stop loss here, and I really want to limit my stop loss to 30 pips or 50 pips. So what I can do is reduce my leverage to 5 to 1, and that would give me an equivalent of a 50 pip stop loss. And if that's too big for you still, you can reduce your leverage to 3 to 1, assuming we started with 10 to 1, and that would reduce the equivalent stop loss to about 30 pips, and then you would not be risking more than you would normally be risking on the original trade. Of course, when the market moves into your direction and you start to make a profit, your profit will be half or a third of what you would originally achieve from the trade. So that's really up to you to decide how much money you want to risk, but I would recommend to you that you shouldn't risk more than 50 pips. So if we need a 100 pip stop loss, reduce your leverage by half. That's quite a simple solution. Let's have a look at some more reversals. There's a pretty good spike low through the Bollinger Band, oversold stochastic. In this case, the body of the candle's bearish, a little bit big, just a little bit bigger than the spike low, but nevertheless not a bad trade. but you can see it didn't really move up much from there. We kind of moved sideways. We could have got maybe 30 or 40 pips out of that trade, but not a great trade at the end of the day. There's a good example of a bearish engulfing candle after a tiny little spike through the 200-hour Bollinger Band. We didn't have an overbought stochastic, but nevertheless, that's a good example of a bearish engulfing candle following a tiny little spike high.